Hello everyone, and welcome back to Dr. Tao's Quant Lab. For the entirety of Chapter 1, we have been looking at the individual pieces on the financial chessboard: stocks, sectors, shorting mechanics, and ETFs. But today, we shift our focus. We are going to look at the external force that moves the entire board at once. In quantitative finance, if you don't understand the cost of capital, your algorithms will eventually be crushed by macroeconomic gravity. And that gravity is controlled by one institution, the Federal Reserve. The Federal Reserve manages the US money supply, and the specific committee that pulls the levers is the FOMC. 8 times a year, they meet to set the federal funds rate. This is the absolute baseline cost of money. Every mortgage, corporate bond, and margin loan is mathematically derived from this one rate. Now, a lot of amateurs get confused about how the Fed actually works. They think everyone in the room votes. They don't. Up to 19 members, including the board of governors and all regional Fed presidents, submit their economic projections. But actual policy is decided by a rotating committee of only 12 voting members. This is vital to remember. The projections we're about to look at represent a broad consensus, not a binding legal contract. 4 times a year, the Fed releases a document called the Summary of Economic Projections, or SEP. The most heavily traded page in this document is the dot plot. Let's look at the actual dot plot released in March of 2026, which is in your textbook here. What exactly does a dot mean? Look at the y-axis on the right. That is the interest rate percentage. If a dot sits at the 3.0 mark for the year 2026, it means that one specific member believes the federal funds rate should be exactly 3.0% by the end of that year. Because the Fed sets rates in target ranges like 3.0% to 3.25%, you will often see this dots plotted exactly at the midpoint of those ranges. When this document drops at 2 p.m. EST, Wall Street algorithms don't care about the outliers at the top or bottom. They instantly scrap the document to find the median dot in the current and next year's column. If that median dot is higher than the market expected, algorithms will trigger massive sell orders across the entire stock market. Because higher interest rates mean future corporate cash flow are suddenly worth less. Okay, but here is the quantitative reality check. The Federal Reserve is historically terrible at long-run forecasting. The one-year dots are highly reliable. The two-year dots are okay, but the long-run column, it has virtually zero reference value. The Fed cannot predict a sudden war, a pandemic, or a banking crisis. Furthermore, the Fed is inherently conservative. They move the dots slowly to avoid sparking a panic, even when the underlying math suggests they should move faster. Therefore, our quantitative rule of thumb is this. Treat the data. Let's treat the delta. Do not look at one dot plot in isolation. Compare the median dot of today with the median dot of previous quarter to see the true trajectory of macroeconomic gravity. Now that we know how the Fed targets short-term rates, how does that actually translate to the real world? In our next lecture, we are going to dive into the bond market and explore the inverse relationship between the US Treasury prices and yields. See you in the quant lab.